Adjustments to income. Above-the-line deductions are more attractive than below-the-line deductions, such as itemized deductions or the qualified business income deduction. These above-the-line deductions, most of which can be categorized as adjustments to income, have distinct advantages over below-the-line deductions. First, these deductions are available to both those taxpayers with enough deductions to itemize, but also to those who are not able to itemize. In other words, they are readily available to most taxpayers. Second, these deductions reduce adjusted gross income, AGI. Lowering AGI can have multiple benefits. AGI is a critical factor in the computation of some kinds of income, deductions, and credits, and almost always, the lower the AGI, the better it is for the taxpayer. Educator expenses. Eligible educators can deduct up to $250, $500 if married filing joint and both spouses are eligible educators, but not more than $250 each. Of the educator's unreimbursed trade or business expenses. Eligible educators are kindergarten through grade 12 teachers, instructors, counselors, principals, or aides who work at least 900 hours a school year in a school that provides elementary or secondary education as determined under state law. Qualified expenses are amounts paid or incurred for participation in professional development courses, books, supplies, computer equipment, including related software and services, other equipment, and supplementary materials used in the classroom. Student loan interest deduction. Student loan interest is interest paid during the year on a qualified student loan. Taxpayers can deduct the lesser of $2,500 or the amount of interest actually paid during the year. The deduction is gradually reduced and eventually eliminated by phase-out when modified adjusted gross income, MAGI, reaches the annual limit for the filing status of the taxpayer. Claim the deduction if all of the following apply. The taxpayer paid interest on a student loan during the year. The taxpayer is legally obligated to pay interest on a qualified student loan. Filing status isn't married filing separately. Taxpayer or spouse, if filing jointly, can't be claimed as a dependent on someone else's return. A qualified student loan is a loan taken out solely to pay qualified higher education expenses that were for the taxpayer's spouse or a person who was their dependent when the loan was taken out, for education provided during an academic period for an eligible student, and paid or incurred within a reasonable period of time before or after the loan was taken out. Tuition and fees deduction. This deduction is no longer available. That is the case as of the time that this recording was made in June of 2019. It's possible that Congress takes up extender legislation which would reinstate tuition and fees deductions. However, at the time this recording is made, which was well into 2019, the deduction is no longer available. Health Savings Account, HSA deduction. A health savings account is a tax-exempt trust or custodial account set up with a qualified HSA trustee to pay or reimburse certain medical expenses incurred. There are several benefits from having an HSA. You can claim a tax deduction for amounts contributed to an HSA, even if not itemizing deductions on Schedule A. Contributions to an HSA made by an employer, including contributions made through a cafeteria plan, may be excluded from gross income. The contributions remain in the account until used. It's not a situation of use it or lose it. The interest or other earnings on the assets in the account are usually tax-free. Distributions are tax-free if used to pay qualified medical expenses. And lastly, a health savings account is portable. It can go with the taxpayer even when they change employment or retire. To be an eligible individual and qualify for a health savings account, taxpayers must meet these requirements. They must be covered under a high deductible health plan, HDHP, on the first day of the month. They can have no other health coverage except what is permitted. They aren't enrolled in Medicare. They cannot be claimed as a dependent on someone else's return. Here is what makes a high deductible health plan. An HDHP has a higher annual deductible than typical health plans and a maximum limit on the sum of the annual deductible and out-of-pocket medical expenses that might need to be paid for covered expenses. Out-of-pocket expenses include co-payments and other amounts, but don't include premiums. The minimum annual deductible for 2018 is $1,350 for self-only coverage or $2,700 for family coverage. The maximum annual deductible and other out-of-pocket expense amount for 2018 is $6,650 for self-only or $13,300 for family. So that means that to be an HDHP, there has to be a minimum amount of deductible, but then also a maximum amount established as far as what the taxpayer would have to pay out of pocket. Contribution amounts are limited. For 2018, for self-only coverage, a taxpayer can contribute up to $3,450. For family coverage, contribute up to $6,900 is allowed. Moving expenses. The availability of this deduction is now limited. For tax years 2018 through 2025, the deduction of certain moving expenses is suspended for non-military taxpayers. If you're a member of the armed forces on active duty, you may be eligible to deduct moving expenses if your move was due to a military order and permanent change of station. You may be able to deduct your unreimbursed moving expenses for yourself, spouse, and dependents. Included are moves from home to the first post of active duty, a move from one permanent post of duty to another, and also a move from the last post of duty home or to a point nearer in the United States. The move must occur within 1 year of ending active duty or within the period allowed under the Joint Travel Regulations. Self-employed health insurance deduction. Self-employed taxpayers may be able to deduct the amount paid for medical and dental insurance and qualified long-term care insurance for themselves, spouse, and dependents. The insurance can also cover a child who was under age 27 at the end of 2018, even if the child wasn't their dependent. One of the following statements must be true. So one of these statements must be true. Had a net profit for the year on Schedule C or F. Were a partner with net earnings from self-employment for the year reported on Schedule K1. Used one of the optional methods to figure net earnings from self-employment on Schedule SE. Received wages in 2018 from an S corporation in which they were a more than 2% shareholder. Health insurance premiums paid or reimbursed by the S corporation are shown as wages on Form W-2. The insurance plan must be established or considered to be established as discussed in the following. For self-employed individuals filing a Schedule C or F, a policy can either be in the name of the business or in the name of the individual. For partners, a policy can be either in the name of the partnership or in the name of the partner. Partners can either pay the premiums or the partnership can pay them and report the premium amounts on Schedule K1 as guaranteed payments. However, if the policy is in the partner's name and they pay the premiums, the partnership must reimburse them and report the premium amounts on Schedule K1 as guaranteed payments. Otherwise, the insurance plan won't be considered to be established under the business, meaning that the premium would not be deductible. For more than 2% shareholders, a policy can be either in the name of the S corporation or in the name of the shareholder. The shareholder can either pay the premiums or the S corporation can pay them and report the premium amounts on Form W-2 as wages. However, if the policy is in the shareholder's name and they pay the premiums, the S corporation must reimburse them and report the premium amounts on Form W-2 as wages. Otherwise, the insurance plan won't be considered to be established under the business and therefore won't be deductible premiums. This deduction is not available if the taxpayer is able to participate in a subsidized plan that is maintained by either the taxpayer or spouse's employer. Penalty on early withdrawal of savings. If funds are withdrawn from a certificate of deposit or other deferred interest account before maturity, the account holder may be charged a penalty. Form 1099 INT or similar statement given to the taxpayer by the financial institution will show the total amount of interest in Box 1 and will show the penalty separately in Box 2. Taxpayers must include in income all interest shown in Box 1. They then can deduct the penalty on Form 1040 as an adjustment. Deduct the entire penalty, even if it was more than interest income. Let's look at some examples. Mr. Jones had a student loan for qualified higher education expenses on which interest was due. The loan payments were required from July of 2004 through December 2018. The interest payments were $1,200 per year. His AGI is $50,000 and he files single. Sorry, there's a typo, but single. How much may he deduct in arriving at adjusted gross income in 2018? Well, the answer is $1,200. We could deduct up to $2,500, but he only paid $1,200, so that would be the amount of his deduction. All the following may take the self-employed health insurance deduction except, well, let's go through the list. Let's start here on item B. A partner with net earnings from self-employment reported on K1. Yep, check, that's good. A taxpayer who used one of the optional methods to figure net earnings from self-employment on Schedule SE. You bet, check. A taxpayer who received wages from an S Corp in which they were a more than 2% shareholder whose health insurance premiums reimbursed by the S Corp were shown on Form W-2 as wages. You bet. The one that doesn't work is right here, and it's a little bit of a tricky question. Self-employed taxpayers who had a net profit or loss for the year reported on Schedule C. Well, everything is fine about this except the loss. We can't base the self-employed health insurance deduction on a loss. We need to base the deduction on some sort of positive income amount. So letter A would be our answer. And then finally, all of the following are ways that taxpayers can benefit from an HSA. Taxpayers can claim a deduction for contributions they or someone else makes to their HSA. Check, you bet. Contributions to the HSA made by an employer may be excluded from income. Check, you bet. The interest or other earnings on the asset in the account are taxable. Wrong. That's not right. Interest or other earnings are not taxable and would stay not taxable if withdrawn for medical expense. So letter C is incorrect. Those interest or earnings are not taxable. And then letter D, distributions may be tax-free if they pay qualified medical expenses. You bet. That's true also. So letter C is the false statement. Okay. Thank you very much for listening to this recording, and best of luck on this part of the exam.